What if you could learn in weeks what it takes the average hedge fund analyst years to learn on the job? What if you could stop guessing at what your PM wants from you or how you should be spending your time and instead feel confident you are putting your efforts in the right direction? If you want to accelerate your buy-side career, the Analyst Academy from Fundamental Edge will give you the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. The Fundamental Edge Academy is taught by a veteran hedge fund analyst and PM, Brett Coffrin. Brett teaches a practical approach informed by his years of experience at some of the top funds in the world, such as Maverick Capital, D. Shaw, Citadel, and Schoenfield. Wonder how top long-short funds approach earnings season? That's covered. How will your PM expect you to add value in the first year on your job? That's covered too. Worried about what makes a good stock pitch? There's a whole module on idea generation and thesis communication. Plus, you'll get access to the Fundamental Edge alumni community, a highly engaged community which in just 1 year has grown to over 400 investment professionals. Fundamental Edge alumni get access to exclusive webinars, case studies, and an invite to their first annual Analyst Spring Training Conference in Arizona. If you want to fast track your buy-side career, go to fundamentedge.com for more info. That's fundamentedge.com. All right, hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have on for the third time my friend Mario Cibelli. Mario, how's it going?
All right, how you doing?
Doing good. Let's start with the disclaimer. Same disclaimer I give every time. Nothing on this podcast is investing advice. Please consult a financial advisor. Do your own work. Remember, this is an investing device. Mario, I'm so happy to have you on today for the third time. I cannot believe it's been so long since the first two appearances. But the main reason I'm happy to have you on, you're a great guest. You do great fundamental work. But I know how seriously you take these things because you were texting me and you said, hey, I'm ready for time number 3. We've got to go 3 for 3. The past 2 stocks that we did, January 2021, we do at the time WWE. It's morphed into TKO. That's roughly a double in just over 3 years since we did it. The first podcast we did, Uber, we do that August of 2020. Stocks under 30. Today it's over 60. So again, about 3.5, approaching 4 years, over a double there. And you said we're going 3 for 3. So I'm excited to have you on. I'm excited how seriously you take these things. But the company we want to talk about today is Xometry. The ticker there is XMTR, and I'll just toss it over to you. What is Xometry and why are they so interesting?
Yeah, and we're going to attempt to go 3 for 3. This is an attempt.
Nothing's financial advice, no guarantees. We're attempting, but I think this is a really interesting story, so I'm excited for you to get the attempt at least.
Attempt at a three-peat for sure. And this company is it's something I've been working on for a year. I think I know it pretty well now. It's a confusing thing to get to understand and get to know, but I think this company, a little company. Look, it's a class of 21 IPO, which we were kind of chatting a little bit before. Be wary of the class of 21 and 22 IPOs. I found a couple of good class of 21 IPOs. We did pretty well with Vita Coco. I think this company Remitly is interesting. I think Xometry is pretty interesting. But there's a lot of dreck during that period. I think this is not one of those companies, though of course it came public at a very high valuation. I don't know, it might have been 38 or 40 or something like that. It's versus the current stock price. But I think they're working on a very big problem. It's not a small problem, and that there's not another kind of company easily in sight that's working on this problem the same way they are. It's a very big market they're addressing. They have classic marketplace attributes, though I don't actually think it's technically a marketplace. Many people wouldn't consider it. And the market they're addressing is bespoke parts, custom manufacturing. These are 100,000 plus job shops all over the world, all over the place, every state of the union here, that are kind of the basic building blocks of industrial manufacturing. There is not a marketplace that exists yet, and I think there's been attempts at a marketplace in this sector going back to like the early 2000s, and no one has successfully done it until this company. So I think they're working on a very big problem, and they've gotten traction. I mean, they're going to do kind of close to $500 million of revenue this year. I think the addressable market here is is absolutely massive. In the S1, I think they used, a huge number. So I don't know. I don't even have it off the top of my head, but this would be all manufacturing. And they have operations in the U.S. and Europe. All manufacturing that would kind of fall under prototyping or non-SKUable parts that are, generally speaking, not massive production runs. These are unique items, small production runs, and so it's a massive market. I'll stop there for a moment.
Yeah, so this is great. So I'm with you. Right at the front, you said it took you've been following it for a year and you've got a good hand. It took me, you and I started discussing this company 3 months ago, I think, and it's taken me, it's not like I studied it every day for 3 months, but it took me looking at it quite a few times to really understand the network and what they're doing here. So I guess the basic start is just tell people like what the network is they do. Because when I heard it, I said manufacturing demand, I was like, well, BMW is a customer. Why would BMW go with them? They manufacture a ton of stuff on their own, or like, they've got the tier one auto suppliers. Why don't they just say, hey, tier one auto supplier, we need more parts, give them to us? Like, kind of explain what they're selling and why the buyer and this, I guess that's the whole thing with the network, but why the buyer and the seller are working with Xometry.
Well, a couple different things. You're just, broadly speaking, manufacturing is going to fall into, one or two buckets. You'll have, large mass production runs. So, BMW is going to make, a lot of this part. Now they're not going to go to Xometry for that. They'd be going to Flextronics or some other manufacturers or some auto part manufacturers that, where price really matters. And we're going to need, a million pieces of this exact same part over the course of the next 2 years. And someone else is kind of going to get that business. And I think those kinds of industrial buys would represent, the majority, I think the vast majority of the total spend on parts that come together to kind of build something in the end. Then you have this other kind of longer, messy tail of all the kind of things that wouldn't fall in that bucket that are shorter production runs or one-offs, uniques, even prototypes. Anything that a very large contract manufacturer or manufacturing entity, it just wouldn't be economical for them to make such things. And these job shops happen to be, they're very small. They're entrepreneurs. They're run locally. There's actually one public consolidator of that business, a company called Proto Labs, which isn't that big. They're not that big themselves, but the vast majority of these job shops that, numbers somewhere close to 100,000 job shops, I think, domestically, and doing all sorts of things. Like, one of the things here, it's hard to grasp a little bit, is the variety of things these companies do, the variety of parts, materials they do, the variety of finishes, everything like that. It's limitless, So anyway, there is this long, messy tail of unique parts that are used and consumed and made by these job shops. Job shops could have as few as just 2 or 3 employees. Many of them are independently owned, and so they're not big. So say a company like Boeing that has a manufacturing facility, they're all over the place, but in the Northwest, they're going to have kind of a go-to group of job shops that they know do good work, that they've used before in the past. Maybe there's 8 to 12 or 13 of them that they continually go to. But for the kinds of orders that we're talking about that are not, super large, they'll have they'll kind of have a group of suppliers that they're comfortable with. And so I think, broadly speaking, those would be two of the main buckets that manufacturers would kind of fall into. Now, I guess where Xometry sprung into being is that the job shops haven't really, of course they have software and whatnot, but it's the exact opposite of how e-commerce is today. it's not an easy thing to get quotes on. It's not like anyone could buy from them. And actually, funny with Xometry, you go in with a credit card. You and I could buy something today. We could design something, have it get shipped to us in a few days with a credit card. That really didn't exist before. But most of these job shops are not able to, haven't made kind of or not even able to make the kinds of investments that would allow that to happen. So they are mostly living in the non-digital world, and they're struggling for orders. They want to fill capacity intelligently as best they can, and the buyer of an aerospace part, in Seattle that needs something very specific, would have really no way of finding a job shop in Indiana that happens to have excess capacity and can make that part, next Tuesday and deliver it out and get it there on time and offer a better price than what exists with their kind of known set group of suppliers. So Xometry is kind of, stepped in this marketplace and has kind of added value to both sides. And I'll kind of get into that, what the buyer's thinking and what the supplier's thinking on why Xometry is attractive in a second. But, essentially what Xometry does at its, I think, most basic, I've thought about this a lot, and I would say that they're experts in pinpointing areas of expertise and excess capacity in these job shops. And no one has figured out kind of how to do that. And like I said, there have been multiple attempts in the past to do that. So I think at its very essence, they're actually not selling a part or a thing as much as they are a service. And that service is very valuable. It's lacking. And therefore, I believe that they're opening the door to a very big potential marketplace over time.
No, look, I'm going to let you dive into the marketplace, but the thing that's really, again, I've been looking at this company on for 3 months. The thing that's really struck me is what you said. If you've got the local job shop in Indiana and they have excess supply, that's really tough if they're without Xometry, because, I think it's the Xometry CEO in a recent call. He said, look, this was business basically still done over the yellow pages, right? You call up, or if you're Boeing, you call up the local job shop and you say, hey, do you have excess capacity? And you just keep calling your list of suppliers till you find one who's got excess capacity. But if you're the supplier with excess capacity, yeah, you can go to all of your buyers and say, hey, do you need any jobs? But if they don't need them, like, how do you find new business? And Xometry can solve that really quickly. And the other interesting thing, I'll let you go into it, but the other interesting thing about this network to me is they said, hey, look, because these are all so custom, if you call up 2 different small manufacturers and you're the buyer, one might quote you, hey, it's going to cost me 2 weeks and $2,000 for this job. And the other, if they have excess capacity, might say it's going to take 2 days and $1,000. So, it's a large network. It's non-digitized, thousands and tens of thousands of suppliers and some buyers. You can really imagine how, as this network is going, even before we start talking instant, how there could be some really powerful benefits of a networking matching effect where, Boeing in Seattle needs jobs done. There's a lot of excess capacity in Indiana. Without this online market, they're never going to get matched up.
Yeah, that's exactly right. It's, I do view it a little bit, it's a bit of a high cost channel, for the suppliers, but it's orders that they really would have no right getting otherwise. And so it's a very valuable thing. I mean, you could look at it, a job shop. Look, it could make sense for them to take a job at break even because they know they have a worker, sitting there. And, if you do it at break even, you have some absorption of variable costs and hourly wages and stuff like that. That can make perfect sense to do. So, I guess for the first time on the buyer side, the buyers are essentially getting to test, a global marketplace against their local suppliers. Now, yes, there's a markup. The marketplace has 30%, a little bit higher than 30% gross margins, and that'll probably improve over time. So, they are taking a vig commission for putting these parties together. But the market's so inefficient that they're very competitive on prices,
Yep.
despite doing that. And
you could imagine if you're only sourcing from Seattle, and the Seattle area, just to go back to the Boeing example, the Seattle area has a lot of demand. You can imagine how having for the first time opening up to Indiana or wherever, if the pricing is 50% lower and, you would have paid $1,000 in Seattle, you pay $500 in Indiana, even if Xometry marks it up by 30%, 40%, like you're actually getting, despite the margin, you're getting it a lot cheaper. So I really like that aspect of the story.
Yeah, it's also, there's something that we noted that you could actually just do on Xometry's site, which is, they have some standard designs of things that you can order. Like I said, you can kind of order something without designing it. If you get a part, if you buy a part, and they have kind of 3 delivery speeds, I think is expedited, regular and economy. The fall off in pricing between those different delivery speeds is kind of breathtaking. I mean, a part tomorrow that costs, $50, might cost you $30 a week from now, and might cost you $24 2 weeks from now. So it really, really emphasizes that, this is about a service and about available capacity more than, hey, what's this part sold for? And I do think that that's an important thing because, used to be, go back a couple of years ago, or how many years ago now, it would be 5 or 6, and Amazon was kind of going to go into every business, and that was kind of a death knell. Amazon put that dreaded press release out. This is very different than that. You actually can't just come in and bash on price. It almost doesn't exist. The early attempts, this goes back to the early 2000s. I recall the early attempts at digitizing this marketplace. I think multiple companies, I couldn't tell you the names of the ones that did it, but multiple companies tried to do it. Where they got caught up on was a request, okay, you uploaded your file, this is what you want, okay, request quote. Request quote. And people would request quote. The problem is that you kind of then went into the old school way of getting quotes, which is trying to get these job shops to drop what they're doing and to respond, to make an offer that would be honored. So the request for quotes slowed up the whole process. The stroke of brilliance, I'll say, the aha moment for Xometry that the CEO Randy came up with was, essentially a buy now button. I'm going to kind of Amazon this space and make. I'm not going to bother with the quote. I can figure that out. So what I'm going to do is, you uploaded it. This is what you want. I'm going to quickly estimate what I think I can buy that part at. I'm going to offer you at a price that I'll honor, irrespective of whether I guessed correctly, estimated correctly what this part will cost me. And you can buy it now, and it's going to be on the way, like done. So the buyers, the industrial buyers that had that opportunity to do that for the first time and didn't have to wait around for, like, will they honor this quote, all that kind of stuff, or even their internal system to do things, emailing, all that kind of stuff, calling, everything. He essentially made Xometry the merchant of record and took the risk on that part, but made the buyer, gave the buyer certainty for the first time. So he started getting a lot of volume. With a lot of volume, he got a lot of data. With a lot of data, he made better and better estimates of what it would cost, where areas of expertise were, who were good in this kinds of finishes. If the capacity is closer to the final destination, well, that shipping cost may be different than if it's farther, all that kind of stuff. And they've gotten better and better and better at that. So that was really the big moment that I think that this marketplace started gelling. And it's still quite small, but it's a heck of a service to offer in this marketplace where nothing like that existed before.
So I just want to make sure we drive this home, because I think this is the most important part of the story here. So in the old way of doing this, or when people used to do it online, you are a buyer. you would literally have to, if you were coming through me as a network, you would say, hey, I want a part, and I would have to, by phone, call up 20 different job shops and say, hey, here's the part, what's your pricing, what's your timing, get that, and then come back to you, and then you'd have to accept it. And you could imagine calling 20 job shops, like that would take multiple days, right? What Xometry does is you come to them and you say, you upload, I'm looking at their page, you upload the CAD or whatever for the part you want and say, here's the part I want, here's everything. And they say, great, we'll get it to you. It's $100 if you want it tomorrow, $75 if you want it a week from now, and you can accept it. And Xometry, as you've put it to me, they're basically short a part, right? Once they give you that quote, they need to go find a job shop to fill it. And since they're charging 100, preferably job shop to fill it at 80 or 70 or 60 or 50, they find the job shop to fill it, get it done, but they're short a part. And then, as you're saying, it's a great business because you get a lot of data and you start learning, hey, the first quotes we did were 100 and we were spending 120. So you can kind of, and these quotes were 200 and it only cost us 80. So you can learn over time what the actual costs are. As you said, you learn more about the suppliers and everything. So that's kind of where the AI learning piece of this is, and the thing that's unlocked the network. Am I thinking about that correct? Did I describe that correctly?
I think that's right. I kind of used a tongue-in-cheek term that Xometry shorts the part to the buyer and buys it back from its suppliers later lower. I think technically, I think very quickly they have a very good idea what it's going to take to motivate suppliers to make that part. So I think their risk is somewhat minimal. And I think they've gotten better at it. I mean, there's certain categories that they get better and better at, where they have clusters of categories. One of the long-term kind of growth drivers for them will be adding more and more services and adding more and more levels of expertise. But essentially, there's this bell curve, kind of like the median order is where they get kind of the margin that they want, and then you kind of have these outlier orders where they made too little over here or lost money and kind of made too much over here. And, over time, they've kind of they've made the curve skinnier, and that's been a gross margin driver for them. So I think, technically, what happens that they figure out, about where the price of that part should be, where they can buy it. And then they show it to, and there's a number of criteria. They show it to the job shop that they think is going to, be the best fit for that part. And I believe, I don't want to, this is not, I can't say this is fact, but from recollection, I believe there may only be like 60 or 90 seconds that job shop gets that first look at that offer. Then it goes to another one, and that first one's still seeing it, but they bump the price they're willing to pay up slightly to the second one, and then to the third one. And so, the faster a job shops, the network takes an order, kind of better on their margins. And I think the vast majority of orders are gone in a couple minutes. So that's a metric they pay attention to, whether they guessed right on the first one, or is it the second or third one that takes the order.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of the year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Training on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick Capital, and he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more about their next cohort at fundamentedge.com. How can a job shop take a job in, you mentioned 60 seconds, 2 minutes, 3 minutes? Because, if the old way was literally on the phone, dialing up job shops, like these are mom and pop job shops, right? 1 to 5 people for a lot of them. I think there's a quote, where is it? Most of their suppliers have less than 25 employees, right? I understand there's automation, and Xometry actually offers a lot of their suppliers some free software, which we can talk about as kind of an interesting angle. But how are they accepting a job in 60 seconds when all of their other jobs are coming over the phone? Like, these guys are actually out there welding and building parts. How do they see, the DoorDash order pop in and say yes or no, price everything, figure out if they've got capacity within a minute or two?
Yeah, the DoorDash and Uber Eats is not a bad analogy there. There's going to be a screen. They have a workshop screen where the order comes in, and that software actually can take all their orders, and if they want to use it that way, it's free software for the suppliers. A lot of them, some of them will have software solutions, other ones will. So they do offer that, and there's going to be a floor manager. There's going to be someone looking for orders. There's someone always thinking about that, and they can set it up with alerts. I think they could get an alert on their mobile phone so they know, and they can react quickly to it. And it's a competitive world. That's the marketplace. So yeah, they're able to react. I assume that there's some orders every now and then that go out that someone would have took if they had known it, but kind of missed it, or they're too busy. So I think yeah, they built it to bend over backwards a little bit as best they can to make sure that the suppliers that want alerts and want to know about it see it pretty quickly. There's no automated phone call going in or anything like that. It is coming in over a screen.
I think people can probably hear how bullish both you and I are on the network and the possibilities here. If you just start thinking about this, as you said, it's manufacturing is the marketplace. Like the thing's huge. But one risk that worries me, and I've seen this more on the consumer side than the business side, but we've seen this happening before. You start this network to match suppliers with buyers. You start it, you get great margins. But what happens is the suppliers kind of try to build a direct relationship with the buyers and just kind of end cut the supplier. I think about like an Angie's List, right? A maid service. A lot of what they would do is, hey, they'd match the maid. And one of the issues they ran into was, great, they would match the maid and they'd really want it to be a recurring relationship. But the maid, when she went to your house, they would just say, hey, Angie charged 100, they paid me 60. If you want to use me again, why don't I just come back next week and you pay me 80, right? So we kind of cut out the middleman and split the difference. I guess my question is, why wouldn't that happen here? Because you could say, hey, Uber, right? You could try to cut out the middleman for Uber, but you don't, because time and fit is really a factor in the liquidity of the network. But this isn't quite the liquidity of an Uber. Like it's you're probably only doing these custom jobs once every couple of weeks, depending on your size. Like, why is this more Uber than that maid example I described, if that makes sense?
I think I've used the Uber example, and I don't think it's a bad counterpunch on that risk. It's something that I thought about initially, a year ago, and I've gotten very comfortable that essentially isn't a real risk. You have fractured buyers, and you have super fractured sellers, for starters. And I think if you attempted to have, and you could, there's nothing stopping you, but if you wanted to have a direct relationship with a new supplier, you could. But then you've just gone back into into your little kind of informal marketplace that you've been using, and you're getting rid of the benefits and streamlined communication that you sought to begin with. So, I definitely say you could take an Uber home, and you could get the person's card, and you could try to cut a side deal with them, but that would start to defeat the purpose of why you like Uber so much to begin with. I think the exact same, analogy works here. They will try to, if you do a duplicate order, the same thing, they will give the original job shop the first crack at that. But I think the last thing that these buyers want to do is to get back on the phone or get into email relationship with someone. And that's not why they found Xometry to begin with. They came to Xometry because they're trying to manage this very kind of messy, long tail, kind of high friction communication for a spend that's critical, but not a lot of dollars. So cutting out, saving some money on this kind of spend it doesn't do it. It's way better to beat up your large contract manufacturer for the million parts you need by a penny or two. You come out ahead versus this. So I really I don't worry about that at all anymore, to be honest.
The CEO, so two things. One, the CEO was at a conference recently and he talked about the Uber comparison. And I was wondering if he came up with that or if he'd been talking to you and you drove the Uber point home to him and he came up, if I was hearing Mario through his words. But no,
it's hard to say. I've used that analogy for a while, so perhaps I used it with him. We visited him a couple months ago and we've chatted with him a number of times.
I do think it's an underappreciated point, especially for people like you and me who stare at screens all day. Like if you're one of these large companies and you're dealing with, let's call it 50 small supply houses, like you'd actually prefer to spend a little bit more and cut down on that relationship management. Like that's a big headache for you. And if Xometry can offer, hey, go through us and maybe pay a little bit more, but you don't have to micromanage 50 individual shops. And actually you probably pay less because we can kind of match excess supply with you guys. And, we can do it pretty flexibly. Like just the time and headache savings alone of not having to manage those 50 relationships would actually probably be worth it to a big buyer.
Yeah, I think it, like I said, the supplier, it could make economic sense for them to break even on that part if it's absorbing any of the fixed costs that are there. The buyers could potentially be paying the same price, but very much create time and streamline their whole process significantly. And I do think that there early on we did some studies and looked at things. And I think there is some savings there, but I really think it's time management and streamlining that is the real hook for the industrial part buyers. And and look, it's you could use both. You could use Xometry to kind of keep your suppliers honest, or you can't raise anyone on the phone. You get frustrated a little bit, and you're like, well, let me get this order in because it's really important. That is that's I think it's I don't think we're going back. I don't think it's possible to go back. Digitization of this marketplace has kind of come, and it came in this unique way where he kind of took, principal risk essentially to speed up the service. It's getting enough traction. It'll continue to get traction. I don't think it's possible for it to unwind, and I don't think there's another good way to do it. I do think, and this is like kind of like I'm thinking forward here. As they add more scale, I do think there's a chance that this business evolves into looking like something different than it is right now, which is it's technically not a marketplace. Their GMV is actually their revenue, and their cost of goods sold is the cost of the part. So, I've talked to some marketplace people, investors, VC type growth fund people that kind of don't like this thing because they're like, oh, it's not a marketplace. And I'm like, I think it has marketplace attributes, but it's not like eBay or something else where there's a take rate on this much bigger, gross merchandise value. The revenue and the GMV are essentially equal, but I also did point out, I got a 30% plus take rate. There's, think that, what does that imply about how much value they're adding? So technically the bucket I put it in, and it's just interesting because it took me some time to kind of become okay with this, and it definitely puts off some growth buyers and some other types of people that may kind of be generally attracted to marketplaces. I consider it a specialized distributor, and I don't think the debate's important, but I think it's more of a specialized niche distributor than it is a marketplace right now. There's very little inventory. They actually have a little bit of inventory from time to time to help certain suppliers with larger orders. It's almost nothing. The real investment is they have some net working capital. They'll pay Boeing in 45 or 50 days, and they'll pay their suppliers faster. In fact, they'll pay their suppliers, these little job shops, faster than Boeing will pay them. That's one little plus that the suppliers like. So they have some limited investment in working capital to grow, almost no inventory. And so I think said another way, I think it's a very attractive distributor, way better than your average distributor who requires a lot of capital to grow. And this has a super long runway in front of it. But that's one way that I kind of think about it, that I believe throws off plenty of people, or makes them hesitate to even consider, this company.
I'm laughing because I know some friends who invest in a lot of specialized distributors, and I texted several of them and said, "Hey, have you looked at Xometry? Like, it's got some blend of marketplace slash specialty distribution." So I was definitely seeing the same thing. Let me ask one more question on the instant quote, and then I want to talk a little bit about the network effects and everything, and valuation, and everything. I do think back to like Home Advisor Angie's List, right? In 2021, now, as you said, 2021 was a different time, but they started an instant quote on consumer roofing. And again, consumer roofing, different space, right? It's consumer, it's local, so you don't have the benefits of being able, Xometry can pull nationwide and ship, whereas I can't exactly, if I give you a quote in Florida, I can't say, hey, here's a Washington, D.C. roofer, let's just import them down to Florida to fix your roof for a few days. But they started doing instant quotes on roofing, and they tried to do it on a few other home things, and they basically blew up. They couldn't make it work, right? They found out that they were quoting too little on the roofs. There was adverse, like all these issues were popping up. I guess my question on the instant quote is like, I guess some should pretty quickly realize if they were doing things negative and price it up and everything, but how can you be sure that they're not, do they have any guardrails in place to make sure that they're not getting burnt and like putting out negative GM after negative GM product?
Yeah, no, they track they track all sorts of KPIs around, around margin, orders that where they don't make money, they make too low of a margin. When you think about it, right? These are uploaded into, well distributed, CAD software that all designers use, and then they kind of upload it, and they ask a lot of questions. What materials do you want? What kind of finish do you want? They have more data than anyone else on that. So I don't view it. And look, and generally speaking, these are pretty small orders. So like if something starts going awry, they're going to see it, and they could self-correct pretty quickly. I think there's going to be upward pressure on the gross margins rather than downward pressure. When they add new categories, of course, and they go for more growth, that could create some pressure on gross margins on the downside, because now they're adding a new service that they have to learn about and do better at, and that there's a bit of a learning curve there. And I think over time, as they add different services and different finishes, and there's so many. That's one thing there's so many ways to skin the cat and make things and do things. There's just limitless. We still manufacture a lot in the U.S. despite people thinking we shipped everything off to China and other places. There's a tremendous amount of things that are still made here. We've become way more productive. I think we manufacture more than we ever have before. We do it more efficiently in a more automated fashion in many cases. But there's just a limitless amount of things that can be made and ways to do it. And so over time, they will continue to add new services. And as they do that, they could have something where like that challenges them a bit. But these aren't, massive orders. They're not signing a 13-year contract with someone and kind of like, oh man, we just promised to deliver this 787 Dreamliner and we're going to lose money on every single one. It's not even remotely close to that. But I should finish one other thought, which is, what could this company evolve to? Kind of gave you the aha moment with, let me estimate what this is going to cost. I'll let you buy it now. There's value added to both sides. But I do think as they continue to get more scale, a little bit maybe like some other business models out there, I do think that they could evolve into more of a pure marketplace, which is, they do these managed buys. They announced two of them recently, one with a medical supply company, and I think another with a European business, where they'll say, let me take all your long tail custom manufacturing business. I want to do all that, and I'll give you a discount. I'll give you a discount off the rack rate, but you have to buy this much in parts, with me over the next 12 months. So they did two deals like that recently. Well, I can envision a time where you have helped them streamline their parts buying in such a way that you actually say, let me take your entirety of your job shop custom manufacturing buys, and I won't need to make the same margin. If you're communicating with your existing suppliers, with relationships that you have, and you want to send them an order, and you want to have that, confirmed quickly back and forth, or, you want to send that to your 12 or 13, go-to people and have them respond, and, you're not really using my algorithm, I'll let you do that. And I'll take a more kind of traditional take rate off that, a very low take rate, and be a marketplace. Or, then if it's not that, then like a subscription, you subscribe. You have to subscribe, and all the job shops pay me something, and I'll streamline, all these customers' orders into you and make your life a lot easier. And so I do think as they get bigger and add more scale, that the market could really evolve, and they could actually become either a subscription kind of business or traditional marketplace, but be underpinned by this very high value added big problem that they're solving, which is, let me match capacity, across time and space on all these little crazy little parts.
That's one of the reasons so Work Center, I believe, is the software that they provide, these small job centers. And that's one of the reasons that's so interesting, right? Because trying to take traditionally Yellow Pages business and putting them into the digital age is difficult. But if you can do it, it's very, very sticky if you can grab that long tail and really integrate with them. And you could imagine exactly what you're saying, where you say, hey, you do 1,000 custom parts a year. And right now you're doing 900 with your traditional suppliers and 100 with us. Why not just integrate with us, put it all through this? We'll put it through our software. I think there's really interesting things there. Let me ask you about cyclicality, because I could imagine this could go two ways, right? This could rise and fall with PMI. Industry's expanding. People are putting through more custom job parts. These guys are doing gangbusters because more custom job parts are going through. Industry shrinking, less custom parts. These guys are doing terrible. I could also imagine a scenario where, hey, industry's expanding. All their suppliers say, screw you guys. I don't need you. I've got people calling me up left and right. I'm completely full. I don't need any excess capacity. Whereas maybe they could be counter-cyclical. Industry's falling. All their suppliers are rushing and saying, we'll do anything just to keep the lights on, right? So how do you think about cyclicality and macro for this business?
Yeah, I go back to my old OTA days, online travel agencies, and I think the model there is not terribly different. Xometry is growing faster than the industry, and there is a PMI recession kind of going now. There's a bit of an industrial recession. There's been a couple good readings, expansion readings lately, but I think for the better part of a year, most months have been in a contracting phase. If you take Protolabs and you back out, they did an acquisition of a marketplace. Protolabs did buy a European, I think it was called HubSpot, or maybe 3D Hubs, I'm not sure, but they did some M&A in the space because they recognize that Xometry is making some progress, and they want to have a competitive offering. If you back that out of their business, you look at their traditional, and again, they're I would say that they're kind of a scaled up non-mom and pop version of job shops with some areas of expertise. Essentially a category killer in that space. Their top line has been down 4 out of the past 5 quarters. So it's definitely a tough environment right now, and Xometry has grown through that. So it's clearly picking up share and solving some kind of problem here where they're having both buyers and suppliers use them, increasingly so, despite less being kind of purchased overall. Remind me the top end what your question was.
Oh, I think you addressed it pretty well. It was just, I could see cyclicality here going either way. You could say, PMI expanding, or I could see, hey, PMI shrinking. All these job shops have tons of excess supply, and they're all just rushing to Xometry saying, give us a job, any job, just so we can keep the lights on.
So that, the analogy I was going to make with Expedia booking is that, you could make the same analogy with a hotel owner. If tons of people are calling them up and the economy's good and they got tons of rooms, they're going to sell a bunch of rooms directly, they're on their own website or, low cost channels. Someone picks up the phone and all that kind of stuff, and so some environment, they're going to feel less need to, show supply to Expedia and Booking.com. But, on the flip side of that, you're going to have lots of consumers that are a little bit less price sensitive, wanting rooms. Expedia and Booking, grew through, both recessions and stronger economies, because essentially this is what consumers wanted. Hoteliers still had difficulty, in managing their entire book and in generating direct demand, in the lowest cost channels for rooms. So I view this, in a similar way. If there's less capacity out there with the suppliers, they may be more choosy and more picky about the jobs that they take from Xometry. On the flip side, the buyers are going to be, a bit more desperate and want things, and lots of orders will come in, and you'll be talking about a better environment overall. So instead of negative, in a shrinking PMI, we're kind of get readings above 50 and be expanding again. That's generally speaking going to be good for Xometry. They may have, their model may not their model, their algos may have to adjust and kind of realize that, oh, okay, we're gonna need to charge a little bit, more for this price. So we'll quote it a little bit higher because we have to pay a little bit more, and you adjust it. But I think most importantly, it's going to be, are their orders growing, well in excess of industry orders, and that's been the case. I think that'll continue to be the case. I think, you're not going to have this massive capacity. You're not going to have massive consolidation in job shops. Like, I just think that's not going to happen. You're structurally stuck with a large kind of mom and pop base, small businesses owned that really will exist indefinitely. They're going to have a hard time finding good orders, and the big buyers are going to have a hard time kind of pinpointing where that excess supply is. So I think the cyclicality will ebb and flow, but by no means I don't think is a gating factor. It'll just have to be managed.
Let me ask valuation. As you and I are speaking, stock price just over 16, market cap about 800, EV just a little bit over that. They've got some low interest converts, if I remember correctly, but they've got a lot of cash that basically offsets that. They've said if they can get to 600 million in revenue, and tell me if I'm saying anything wrong, they think they'll be about adjusted EBITDA break even. They can probably do 600 million revenue. They'll be run rating it by the middle of 2025. Maybe a little bit sooner than that, but 800 million EV, still not break even adjusted EBITDA. Obviously, you need to get a return on your money, so the EBITDA is going to have to grow pretty quickly after that. Like, how do you think about the valuation? Why do you think this is kind of an attractive opportunity when I just kind of lay out that math?
Yeah, well, look, again, we have a company that's not making money, and EBITDA break even is still GAAP net loss, and we've had lots of discussions about GAAP earnings at SBC and all that kind of stuff. And
I think they said 5% of sales goes to stock-based compensation, if I'm remembering correctly. So $600 million adjusted EBITDA break even. That's 30 million-ish in stock comp. So that's another 30 million in profits you need to find somewhere.
Yeah. So I can't say, hey, I've just mapped this out to 20 times earnings 2 years from now. That's not the case. That I think they're working on a very big problem, and I think they potentially have years of growth in front of them. I think that they are in the process of inflecting towards profitability, and the way I think about them is that if they're growing well in excess of the industry, and they currently are, that says a lot to me. So I don't think that shareholders, at least this shareholder doesn't. I don't want to put a gun to their head and say, I demand that you hit GAAP profitability kind of straight away. I don't think that makes any sense. I think as long as they're continuing to make progress on this very big problem, and they're getting closer towards adjusted EBITDA break even, then eventually GAAP break even, that makes a lot of sense if you're working on a very important problem that you've barely penetrated, and I think that's the case here. They have had some missteps since they went public. That they promised a lot of growth initially, and the growth rate came crashing down. They were going to get into the selling supply business, to all these job shops, because they had all these relationships and were sending them valuable orders. let's send them more services. And that didn't work out. They've shut that business down. But I think one of the things here that's interesting is that their overall revenue growth is kind of is one number, and then there's the marketplace growth number. That's another number, and then even more importantly, there's the underlying order growth rate number, which they don't actually give, but you can kind of make some guesstimates towards. And that number is growing in the low 30s. And now, like I said, we're still in an industrial, kind of semi-recession here. So when I see that, and I think of that kind of extending outward, I think that that indicates to me that they're adding a lot of value in the marketplace.
Can I ask a question there? So this is just something I was trying to think about the networks and tipping and network effects. 2023, if I've got my numbers correct, active buyers on the platform increases 36% and marketplace revenue increases 30%. So that would kind of imply that the revenue per buyer drops. And obviously new buyers are going to do less than old buyers and everything. But I just kind of thought that there'd be a little bit more seasoning or spice where marketplace revenue would be increasing as marketplace revenue per buyer would be increasing. I was surprised by the difference. Does that question and that concern kind of make sense?
Yeah, and this is part of the reason why I think the shares, have come down recently, and to me are presenting an opportunity. We bought shares a year ago around the same price, and then the fall they had a very big run, and then they've come kind of crashing down back to our original price. And there's been some headwinds. From mid 22 to the first quarter, I think here, and the most recent peak in revenue per active buyer was like $2,300 per quarter. Now that number is $1,800. That's been a 20% decline, and there's been two main reasons for that. The first reason, which was kind of helped present the opportunity a year ago, I told you before that delivery speeds have a very, very big impact on the price of the part. People last year, when the economy started slowing down, the industrial economy was kind of getting weaker, they started taking slower delivery of parts to save money. So you can have small shifts in delivery speed in your customer base to create a fairly big headwind. And that occurred starting last year, and it stabilized. And by the fourth quarter of 2023, essentially they had gotten to a point where that number was kind of the same year over year, and the revenue growth rate of the marketplace closer matched the active buyer growth rate and order growth rate. Order growth rate and active buyer growth rate are probably kind of within spitting distance of each other. And essentially, our bet a year ago was something like, okay, that'll be pretty interesting when the order growth rate, the revenue per order, essentially the delivery time kind of isn't declining on a year-over-year basis anymore. And that occurred in the fourth quarter. What happened more recently, and why the shares got kind of weak again, is that some of their larger orders weren't coming in. So there was kind of another leg down. So that created a bit of a sequential leg down, and are kind of at this lower rate of $1,800 per active buyer revenue there. And that, their average order size is quite small. I actually don't know what it is. But there are some large orders. There's some orders that are, could be, 50,000 upwards of 100,000 orders. They have some very big orders. And some of the big, and those generally correspond with larger accounts, larger purchasers. And some of those orders didn't come in or came in light. So if they ordered 100,000 parts Q1 last year, maybe they only ordered 75,000 this year, kind of reflecting, their current outlook, for demand. So that was another headwind that came that they're now fighting. So essentially, they've had a 20% headwind off the peak in that time, they've still grown the marketplace, very significantly, and the active buyers very significantly. So this, to me, is presenting as kind of a similar setup as last year, where the underlying KPIs of the marketplace are exceeding the marketplace's current revenue growth rate. But that should start to normalize as the year wears on, and there should be some convergence there. So to me, we had this little bit of an insight recently, which is just how levered this business is to active order growth, and they've continued to grow active orders at a high rate that's still in the low 30s. And then the revenue per order, which is also very influenced by the number of things that are bought and the speed at which they're delivered. So you also have this situation where Xometry's rate of revenue growth could really accelerate at one point this year if there is a little bit of a pickup after 12 months or so of difficult PMI readings. If people start wanting delivery a little bit faster, and they start ordering a couple more parts back to the kind of parts they were a year ago, they could have a breathtaking acceleration in revenue growth for the marketplace. And so I kind of feel like you're waiting for that convergence to occur over the course of this year, but you also kind of have a free call on any uptick in industrial activity. And we all know, with all the supply chains and everything like that, look, here's another aspect of the business. They have like zero visibility into their order book. They get orders like, you see 2 weeks ahead and 3 weeks ahead. Now they're starting to like, hey, I'll help you manage your entire book, and they have some companies that are kind of committing to a committed buy, but that is a small minority of the orders. They don't have a lot of visibility. They know the orders are coming, but they don't know when they're coming. And if you think about the multitude of use cases here, it's really it runs the gamut. So you could have you could have destocking that has hurt them and all sorts of other things. And if there's any kind of whiff of acceleration, I need restocking of those parts. I want them a little bit faster. And that project that we were working on, where all that prototyping that we put on hold, like that's back on. Like you could have like massive acceleration in order growth and revenues this year. So that's just something that's actually worked against them for a good 2 years now, and it won't always work against them.
Two last questions to wrap up. They're related, but the answer is almost certainly different. There is a decent short interest here, about 10% of the float. So my two related questions are, number one, what is the short seeing that there's, it's not the greatest in history, but I'm kind of looking at my Bloomberg short model, and they say, hey, this is kind of high short interest, kind of maybe some chance for a short squeeze. So number one is, what are the shorts seeing, or what do you think they're seeing? And then my second question, which is related but probably different, what keeps you up most at night about the company?
Yeah, I think the shorts, and look, it's been a successful short. If you shorted it, at it around the time of the IPO, that I think that was a wise thing to do. The run up, in Q4 last year, that valuation definitely got aggressive. I think they're looking at a company that's, not making money. That's a small cap. Those are two strikes against it, right there. They pushed back their, they had visions of breaking even the fourth quarter, and now they've pushed that back. And they even actually kind of said it in a unique way, which is, here at this level of revenue, we think we're going to be, EBITDA break even. So rather than pinpointing the time, they pinpointed a level of revenue. And I think the combination of all that kind of definitely put some people back on their heels and probably emboldened the short some. And look, it's hard to tell which companies now are in fall in certain baskets and factors, and is there some underlying analysis that people are doing that I'm missing? I don't really think so. I think it's now at sort of the market cap's demonstrably smaller, but I think they're working on a pretty big opportunity still, and it's going to take really good execution. I mean, we haven't really talked too much about that in the management team, and I'm now seeing, like, I barely scratched the surface on my notes here, and here we've gone on for time.
People are always like, how am I going to do an hour-long podcast? I'm like, dude, if you know the company and you're passionate about it, I'll say, hey, we're coming up on an hour, and you'll be like, but I'm only one page through my notes.
We've barely talked about it. I think it's a hard one to get.
It is, as I say, I think we started talking about it probably before, but we really started talking about it in March. And I would tell you, it took me rereading at this time, they only had the Q4. I had to reread the Q4 call like 3 times. I did some expert calls. It took me a while just to get because it's a network effect, but it's a business to business small. It took me a while just to get in my head around kind of what they're doing. And obviously all the benefits that you're talking about, it really took me a while, but once you see it, maybe it doesn't prove out in the economics, but you can really understand why there's a chance that this is such a powerful network and why they're really solving a problem here.
Yeah. So I think, look, there was a short report that came out a while ago, and I think that was well timed, and that made sense. And that was, making a churn argument. I don't think you can definitively prove the churn rate out here, but I will note, and I've talked to the management team about this, I will note, as the companies continue to grow, if they were churning through active buyers at a rapid clip, it would be exceedingly difficult for them to continue to grow, especially in a bit of industrial recession, and do higher and higher numbers. That means that they are really churning the heck out of active users and disappointing them terribly, and they're replacing all of them with newbies that are soon to be disappointed. I really don't think that's the case. Now, I'm not paying some super large premium to kind of make that bet and that investment here, but it seems very, very unlikely that they're disappointing most of the customers the first chance they get to do that. I don't think those numbers work. The company did put out a response to that, which is a cohort analysis, which talks about the revenue from each of the cohorts over the years. I think going back to 2016, and you kind of can see the revenues per year are up significantly from those early cohorts, and the more recent cohorts are starting at a much higher rate of revenue in the first year and continuing to grow than the early cohorts. So I think, to me, my guess is there probably isn't a smoking gun short thesis on Xometry, but Xometry, unfortunately, they've put themselves a bit of in a penalty box where they have to prove now. They have to prove that they can get to where they're going, and that they could break even. Even
one small thing,
move forward.
You can tell. One small thing they do, like, they haven't done themselves a ton of favors, because I generally like how they talk about the business. I mentioned they gave out the Uber conversation. I think they do a good job of explaining the network effects. But like in Q4, they say, hey, we're guiding based on how January is trending and everything. And they said January is trending kind of soft. And then in Q1, they guide and people say, hey, last quarter, you talked about intra-quarter sales. You talked about how January trended. Can you tell us how sales are trending in April? And they're like, nope, we're not going to talk intra-quarter. And, that type of like shifting the ball and shifting what should disclose, that's the type of stuff that people start saying, hey, are they just kind of moving the ball? Are they trying to hide something from us? Or, that's just one small thing, but it's one thing that jumped out to me.
No, I noticed that. I think the sell side absolutely picked up on that. You transitioned into a new CFO, and so
true.
The instinct is that the new CFO is wanting to be maybe a bit less granular in things than they have in the past. And I think that potentially makes sense. And I think it was actually, I couldn't recall the last time I heard a company say, here's the revenue that's going to help us get to break even, but didn't pinpoint the time. And it's potentially a good way to do it. You're kind of saying, I don't know exactly where I'm going to show up in revenues, but at this level, I'm kind of going to be break even, and they're not too far from that. So, my instinct is that it's been a good short. A lot of small caps have been a good shorts. A lot of class of 21 IPOs have been good shorts. It's been a good short, but I don't think this company is not making progress. They're definitely making progress, and they also don't have someone standing over them, like competing the hell out of them. They're the innovator. They're the company that's created the market, and they're growing the fastest, and they're going to, they have the most incentive to make it work. So it's not like their missteps have been caused by someone else kind of coming in and changing the environment or being more competitive or trying to, make them lose their money or something like that. It hasn't. It's still small enough where I don't think it's gotten kind of on the radar of would-be competitors. And, I think there's a variety of ways that competition could come at them. So I don't think it's a single thing. I think there's been some missteps. And it's a bit of a show me story right now. And, I think, well, to get to the second part of your question, and this is probably the most important thing, and, I guess to kind of frame my whole interest in Xometry properly would be, I guess when we talked about Uber, that was a pretty risky thing, but it seemed very clear to me that they were going to kind of end up where they were going to end up. With WWE, there's risks in all these companies, but like that one, that was a pretty high conviction call, and I think we've been debating that like 2 months to do it, talk about it 2 months before, and it shot up a little bit, and even then worked out. I would say I'm very, very intrigued by this company. I'd put it in like a higher risk, high wire act bucket. So like, don't run out and buy this thing. But I think I've mentioned to a lot of people, so many people I've mentioned to are, I'm going to keep an eye on it. I'm going to think about it. I kind of wanted to put some thoughts out there because, I'm open to being wrong on this. I don't think I am. But I think they're working on such a interesting problem solve that isn't going to go. You can't put the genie back in the bottle here. It's out, and someone's going to get this marketplace right. And if it's not them, maybe it'll be someone else. But I think they have the pole position. So it's a risky thing, and I kind of want to have it. I wanted to have a debate with you or someone, and I've talked about it with some other people too. So I wanted to put it out there and see what other people think. We do own it. We haven't bet the ranch on it, but we own it and we like it. And we continue to dialogue with them. But the biggest factor to me, the biggest risk, the biggest concern is it's going to be execution. That's all it's going to be. I think this model is very interesting. That part to me is not the debate. I don't think people would say, hey, that's not so interesting. They're not solving a big problem here. They would say all that. But to get it to the next level, the correctness of the execution from here, it's going to have to be pretty goddamn good.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as their guest speaker series. It recently featured TED CDs of capital allocators. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. For job seekers, there's the Talent Hub, which helps both Academy graduates and other buy-side candidates connect with top funds looking to add new analysts. Alumni, including students enrolled in the upcoming January cohort, are also invited to the inaugural Analyst Spring Training Conference coming up this spring in Scottsdale, Arizona. Attendees will engage in numerous learning sessions while building their buy-side networks, and then they'll enjoy some spring league baseball and the amazing Arizona weather. If you'd like access to all that Fundamental Edge has to offer your career, visit fundamentedge.com for more information about the next Academy cohort. That's fundamentedge.com. What do you think the execution risk is here, right? Because I think eBay was mismanaged for 15 years. And now that network had already been built out. That is true. But it was mismanaged for a long time. And once you get that network going, it's really hard to break the network. And here I understand this network hasn't hit full scale or come close to it. But to my non-knowledgeable eyes, like I don't know of any other place that's got the buyers and sellers match with that instant quote. And it's really hard to recreate 5 years of data with that instant quote, that buyer and seller catalog. Like, what do you think the risks are? Because the great thing about networks is once you have the network effects really going, it should tip your way and it's almost impossible to break.
Yeah, well, look, that they're not eBay or PayPal yet, both of which, especially PayPal have had their struggles, but they do have this underlying economic engine that's been churning, for years and years and years. They're not there yet. So like, if they get to that, that to me would be a great victory, but they're not there yet. Like, let's say, I don't know, 18 months from now, they hit gap break even. They're gap break even. They've covered their SBC and they just hit break even, and they're still growing, somewhere 20 to 30%. That to me is pretty darn interesting. But I just think it'll take a lot of good decision making, a lot of good execution to get there. The marketplace, their marketplace, hasn't gelled yet to the point where they could kick back and be like, well, we got a profit driver here, like it's on autopilot. They're going to have to innovate. They're going to have to do a great job. They're going to have to add new services. We didn't even talk about, they made this acquisition of this Thomas, like yellow pages of industrial manufacturing that honestly, just to be quite honest, I don't know. It seems like it fits in, but like I do worry that that's a distraction, that they shouldn't be spending any time thinking about anything other than the big play on this marketplace.
One worry I have here is when networks tip. I just remember eBay being like, "Hey, we couldn't handle the checks that were getting put into the mail or something." Right? Once a network tips, like the growth kind of accelerates. And one worry I have, like when you and I talk about it, it makes so much sense. And 24% marketplace growth in Q1 is nothing to sneeze at. But I kind of wonder, like, it seems so much better for both sides. I kind of wonder why we haven't seen just like the deluge, right? Where they say, hey, every buyer on our platform's increasing and buyers are rushing in and every supplier is trying to get online to fill up capacity. I understand that's maybe a little bit of a pipe dream, but it seems to me like they've got a better product. They've got a lot of levers. And I just don't know why it hasn't fully tipped, if that makes sense. And again, I'm not an expert on the company, but
it's hard to tip markets that have kind of operated a certain way for,
150 years.
Yeah, it's really hard. I mean, I'm a professional analogy maker. Like, we own this Zoom, which is a digital remittance company that PayPal bought, I think, in 2015. And, we were like, wait, hold on. Zoom is charging lower fees in Western Union, and you could do it from your phone. You don't have to walk to the store. Instantaneous. Oh my God, they are going to put Western Union in a hurt locker over time. And the company was growing very fast initially, and then the growth rate went lower and lower and lower. And then it had one quarter where it grew like 12%. And like, what is happening? Like, why can't this grow? And this is years into the mobile revolution, years into internet. And it's one of those questions. How do you penetrate a market? How do you make it go over? And their growth rate plummeted to such an extent, they ended up selling to PayPal, and they got a pretty good price. And I think PayPal is, like a lot of its M&A, was probably not the best M&A they did and mismanaged it. And we couldn't believe that it wasn't growing at a faster rate, but the customers weren't ready for it. And then now a company that I'm interested, maybe next year we'll talk about that one, Remitly. Remitly is now growing at in excess of one Zoom every year, a 2015 Zoom. Remitly is going to do like $1.25 billion of revenue this year. And at that scale, it kind of just blows my mind. So here it is, 9 years later, where I was like, this market is going to tip. And little Remitly in Seattle, Washington, run by Matt Oppenheimer, kind of did it and is almost, and soon is going to be half the size of Western Union. And I couldn't tell you why that didn't happen 10 years ago. I thought it would, and it didn't. So I just think and this is why it's so hard to manage. Like, Randy, he's an entrepreneur, and I'll just got to say, so the biggest risk, I know this is the last question and we're over your hour, but Randy's an entrepreneur. And he's very smart. He's driven. He wants to do a good job here. And I think that it's a small company. And, to some extent, the fact that he has the co-founders own about 15% of the company, And they do have voting control. There's two classes of shares. The second class gets 20 votes. And okay, I'm fine with that. I'm long-term oriented. I get that. But to have kind of two co-founders involved with a real stake, and they care to make it better, and they want to see this work, that's going to put them ahead, especially in small cap land. That's going to put them ahead of 90 to 95% of the management teams out there. Still, though, this is an evolving market, and it's the biggest risk to me. Am I going to get like good decision after good decision after good decision, from this management team? I think they've demonstrated competency. I think they are very motivated to get it right. They've done a lot of good things right. That aha moment, that is very first idea to put the buy now button, get a lot of credit for that. But, that's in the rearview mirror. Now what are you going to do next? How are they going to execute against this very large opportunity with a whole organization, with lots of people? They're not on the West Coast. They're in Bethesda, so they're not, a West Coast tech company. How good are they going to be at getting this marketplace to kind of digitize? I think they have the markings of a company that could do it, and they solved a lot of good problems here. But I'd have to say that keeps me up at night. Could they actually do it, or am I more in that Zoom camp where like I'm dreaming about this thing and it's actually going to be 10 years from now, someone gets it right? Maybe it's them, maybe it's someone else, or the company that maybe wants to buy them and have it for themselves. Or is it kind of like Remitly, and Remitly has gone over and is acquiring customers hand over fist, and NASDAQ, of course, is down on its butt now too, which kind of has made me interested in it again. I don't know the answer to that. I don't know how to like gauge that, but I will say, if they continue growing at this delta above the marketplace, for another couple of years, that tells me they are doing it. And at $500 million of revenue that they're extracting from kind of the purchasers here, you start adding enough scale, and like you get better, you hire smarter people, you keep getting better, you go boom, 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 and then it's kind of yours to lose. I think it's theirs to lose at this point. I do. I think it's theirs to lose, but that's the biggest risk.
It's just so interesting because the network effects of having the buyers and suppliers matched, plus the data network effects of having that buy now button. I mean, as you said, the question is the execution. If now's the time, if they can get it right and everything, but if they can, that is a heck of a moat. But question's the execution, which that's called a cliffhanger. We'll have to follow up in 18 months and see if we've got anything else. But Mario, longtime listeners know if a podcast runs over an hour, it's because I'm having a lot of fun and I'm really interested in the idea. And you and I talked for 20 minutes before this podcast got rolling. So this has been great. But I appreciate you coming on. I've got fingers crossed we go 3 for 3, and we'll have to do. We can't wait this long to do podcast number 4.
All right, sounds good. Thanks for listening to me rant about this one.
I loved it. I'm really fascinated by it. Talk to you, Mario.
All right, take care.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.